Welcome to the Cambridge Financial Podcast with Bert Salazar, CEO at Cambridge Financial Partners, LLC. This podcast is all about tax-preferred retirement planning, economics, financial risk management, and achieving a risk-free and successful financial life. Now, your host, Bert Salazar. Bert Salazar.
Good day, everyone. Welcome to another Cambridge podcast. First and foremost, I want to wish you all a happy new year. This is the first podcast for Cambridge in 2018. So we're very, very excited. 2017 was a very good year for us, but obviously we're thinking that 2018 is going to be a really, really good year. A lot of things are going very, very well. And today what we're going to talk about is the new Tax Cuts and Jobs Act that was just passed by Congress on December 20th of 2017. So I'm going to give you a lot of feedback on that. It's not going to be a very long podcast, but I do want to give you some good information relating to this topic. Now, I had done another podcast in which we covered some of the benefits, the pluses and minuses of the proposed tax cut, but no one really knew until it passed. So now that it has passed, I'm going to give you some very good information so you can start doing some proper planning for 2018 and beyond. Now, President Trump signed it into law on December 22nd of 2017, and I'm going to give you some of the highlights. Obviously, we're still waiting for the actual verbiage because I always like to read through those items due to the type of work that we do for clients and the tax planning that we do. But I'm going to give you a comparison between the 2018 and the new tax law and the old tax law. So we're going to start with the child tax credit. As you may or may not know, the prior law was at $1,000, which was refundable, meaning that if you didn't have a tax liability but you did have a child tax credit, the IRS will pay you or will actually send you a check, for $1,000 because of the fact that it was a refundable tax credit. If it's non-refundable, then you get the credit, but if you don't have any tax liability, you wouldn't get the money. So the fact that it is a refundable tax credit, that's a good thing for all taxpayers that can qualify for the child tax credit. The difference between the prior law and the new law is that the prior law was $1,000, which was refundable up to $1,000. The new law brings it up to $2,000, and it is refundable up to $1,400, so that's a good thing. As far as the individual rates, there were changes made to 5 of the 7 individual rates. The old rates were the 10, 15, 25, 28, 33, 35, and 39.6% rate. The new rates are the 10, 12, 22, 24, 32, 35, 37. So there is a reduction in the tax rate, and it's also expanding the way the brackets work. So I'll cover those with you as well. As far as the standard deduction, for most of us, if you were married filing jointly, the prior law, the maximum was $12,700. If you were single, it was $6,350. And if you were filing as head of household, it was $9,350. Under the new law, if you're married filing jointly, you're going from $12,700 to $24,000. If you're single, you're going from $6,350 to $12,000. And if you're head of household, you would go from $9,350 to $18,000. I think based on my perception of what it will do is it's going to reduce the number of people that are going to be filing or they're going to be itemizing their tax deductions. Usually about 25 to 30% of Americans would actually itemize The rest of Americans normally take the standard deduction, which is more than likely higher. Because of the fact that the standard deduction rate has gone up, there's a high probability that people that itemize will actually be reduced. So we may end up anywhere between 15 to 20% as opposed to 25 to 30% of people that will actually itemize. As far as corporations are concerned, the maximum corporate rate under the prior law was 35%. The new law is 21% flat rate. So that's an enormous benefit for corporations. And it will allow them to do, as you already seen, to do different things with their monies and benefit their employees and be able to expand their corporate and inventory and increasing business opportunities that will benefit the majority of Americans as we move forward into 2018 and beyond. As far as the alternative minimum tax, which is one of the taxes that I hate the most, because sometimes you, when you do tax planning, you do a really good job for a client, but if you do such a good job that the client may have a much lower tax bracket, the AMT kind of brings it back up. And for many, many years, the AMT, the alternative minimum tax, was not increased due to inflation. So more and more Americans were falling into the AMT liability than before. So that was a really bad thing. Under the new law, the AMT has been reduced, and for corporations it has been repealed. So that's a good thing as well. As far as the personal exemptions, and under the old law, the personal exemption was $4,050. Just by being alive, you could claim the personal exemption. So, for instance, a husband and wife would claim their standard deduction of $12,700 plus a $4,050 for each of them, for a total of $8,100 for personal exemptions. Now, those personal exemptions have been repealed in the new tax law, but obviously you can make up the difference with the increase in the standard deductions. Now, as far as state and local taxes, and we've been hearing quite a bit about that in the news, up until 2017 under the prior law, if you paid state and local income taxes, you could deduct those against your federal income taxes. Under the new law, you can still do so, but there's a maximum of $10,000 deduction. So I would imagine for people that live in very high state income taxes, like New York, New Jersey, Maryland, California, they may end up paying more in taxes because of the fact that there's a limitation on what you can deduct from a business and tax standpoint. Mortgage interest is another big issue that has been talked about quite a bit. Under the prior law, the mortgage interest deduction had a limitation of $1 million. Under the new law, it goes down to $750,000. Now, if you happen to live in a state like California, where I lived for many, many years, and I did very well financially, so I had a property that was worth almost $2 million, then obviously there I would have been hurt by the new tax law on mortgage interest deduction, because I could only deduct up to $750,000 from that perspective. In the whole scheme of things, when you look at real estate ownership in the United States, perhaps 4% of the population may be hurt under this issue with the mortgage interest deduction, because anywhere between 95 and 96% of the U.S. population do not own real estate properties that are worth more than $750,000, or they have $750,000 in loans with them. One of the interesting things that I've noticed in reading the law is that, yes, you do have the higher standard deductions. Obviously the child tax credit is higher for those of us that still have children, and so forth. But one of the things that I try to do is I want to do comparisons. So I've been doing some comparison income tax returns for some of my clients, and I've done around 14 of those so far in the last 2 weeks, and I did that during the holidays. And let me walk you through what the new tax laws and the brackets will entail. Now, as you understand, we still have the 7 tax brackets as we did before, but the actual tax brackets are being reduced. And not only the tax bracket is being reduced, the tax liability is being reduced as well. And I think this is one area that's going to help, at least 80% of all Americans along those lines. So I'm going to give you a prime example. And I'm only going to talk about married filing jointly. So if you happen to be a husband and wife and you're filing jointly, under the old law, and you know that taxes are progressive. So under the old law, for the first $18,650 after you took all your deductions, you would pay a 10%. Then from $18,651 to $75,900, you would pay 15%. From $75,900 to $153,100, you would pay 25%, and so on. Well, the same thing applies to the new law, except that the numbers are different and the brackets have been widened to include more people in the lower tax bracket. Now, what do I mean by that? Well, basically, this is what I mean. Under the old tax law, let's say you have a couple married filing jointly, and they earned anywhere between $75,901 and $153,100. And I'm talking about taxable income after all deductions. If it was between $75,900 and $153,100, then they would have to pay $10,452 in taxes plus 25% over the $75,900 mark. So if you had somebody, husband and wife, earning $150,000, then they would have to pay $10,452 plus the difference between $75,000 and $150,000, which would be another $74,000 and change at 25%. Under the new law, the same family would pay, instead of $10,442, they would now pay $8,907, and then in the old law it would be over $75,000, and the new law would be over $77,000. They would only pay 22% as opposed to 25%. So not only is the married filing couple in 2018 getting a reduction up to that $75,900 based on the progressive income tax, because they're paying $8,900 now as opposed to $10,452, but any amount above that up to the in this case up to the $165,000, they would only pay 22%. So that's a win-win for the majority of the clients that I deal with. The second bracket that I also deal with are clients that I do fairly well financially, and under the old law, these clients were making somewhere between $153,000. I'm just using a round-off number for that, and somewhere around $233,000. If you were a client of mine in 2017 and you had taxable income between $153,000 and $233,000, you would have paid $29,752 in taxes plus 28% over the $153,000 threshold. Under the new law, instead of paying $29,752, you would pay $28,179, but you would only pay 22% over $165,000, where before you would have paid 28% over 153,000. Now, obviously, as the numbers continue to go up and the filing status and the taxable income increases, you will see that the numbers start to lower or dwindle a little bit, because at the end of the day, the way that this tax law was put together was to benefit the majority of the middle class Americans from a business perspective. So that's something very important to keep an eye on. Now, as you may or may not know, the centerpiece of the legislation was to create a permanent reduction of the corporate income tax rate, from 35 to 21%. And when you do that at the corporate level, then you're opening a tremendous amount of economic doors that could be very beneficial to Americans. I hear some pundits don't like the idea of trickle-down economics, and trickle-down economics always works. Usually when I have a conversation regarding trickle-down economics with someone who feels that trickle-down economics does not work, the first question I ask is, well, what is trickle-down economics? And the answer is they have no clue. And they have no clue because they don't understand how economics works. And at the end of the day, if the government is able to take less of our money and allow us to do with our money what we feel we should do and we could do better, then chances are we're all going to benefit as a society from a business perspective. Now, obviously, other business provisions are shifting more to what is known as a territorial tax system, in which primarily businesses pay taxes only on U.S. income. Now, that allows for certain incentives in order to repatriate foreign profits. Some companies have already announced that they're going to start bringing, profits that they have parked outside the United States, and they're going to be bringing those profits into the U.S., and that can only create more and more benefits for Americans in the marketplace. Now, also, there's a 20% deduction, and this goes through 2025 on certain income, from pass-through businesses such as LLCs and so forth. Now, the income tax rates, as you already heard, has been reduced, but obviously this is going to be only for years, and the reason for that is that, had this been done permanently, then there would have been a great probability that there would have been a filibuster in the Senate, and that could have delayed the passage of this law. But we'll see what's going to happen 8 years from now. We'll see which party is going to be in power at that point in time. But there could be a probability that taxes could be going up again at some point in time in the future. So therefore, at least for the next 8 years, a lot of my clients are going to have a tremendous opportunity, because you're going to have the ability to start to shelter more and more of your income and putting those dollars into tax-free investment tools and tax-free retirement planning. For instance, many of our clients today have a lot of money in qualified plans like IRAs, 401ks, and so forth. And the only way to create tax-free income is that you need to be able to pay the tax today and then shift that money over to plans that will grow on a tax-preferred basis, and then on a guaranteed basis, you will be able, based on the way the law reads, you will be able to pull the money out tax-free. Well, in order for you to enjoy that, you have to be able to pay the tax today. But if today the taxes have been reduced, you're actually in a very good opportunity, because it's a sell-off. For the next 8 years, you as an investor are going to have to take a look at your taxes, understand your tax liability and what it may look like, 10, 15 years from now, and then start shifting some of those assets to investments that are going to grow tax deferred for the rest of your lives. Now, what are some of those investments? Primarily, there are only 4 in the United States, and I have talked about this before. Your Roth IRAs, your Roth 401ks, your municipal bonds, and life insurance. Now, municipal bonds, although they're federal income tax-free, they do have a negative impact on Social Security distribution because they get counted against for provisional income calculations, and that would be for another podcast. We're not going to get into that right now. So in reality, the only three investments that you can make in the United States where the income could be totally tax-free would be your Roth IRAs, your Roth 401ks, and your life insurance. And for those of you that don't know much about life insurance, I would encourage you all to start doing a lot more research. Feel free to reach out to us if you have any specific questions, because at the end of the day, this would be a great opportunity for many of you to start sheltering money into life insurance contracts that in many states are creditor protected, and most important, will grow on a tax-deferred basis, and you will be able to pull out on a tax-free as well. So it's a win-win for everyone from a business perspective. So, we're very excited about all of these tax deductions. Now, obviously, medical expenses, for the last few years, your medical expenses had your adjusted gross income threshold was 10%. It used to be 7.5%, but for 2017 and 2018, it's going to go down to 7.5%. So anything above, so for instance, if you have, and this is a confusion that many of our clients have, let's say that your adjustable gross income is $100,000 for the year. Under the 10% rule, that means that $10,000, 10% of $100,000, if your medical expenses are under $10,000, then you cannot deduct them. You can only deduct medical expenses in excess of that 10% or $10,000 threshold. Well, that threshold in 2018 goes down to 7.5% or $7,500. So if you had $10,000 in medical bills, then now you're going to be able to at least deduct $2,500, where under the prior law you wouldn't be able to do that. So that's a very good thing from that perspective. Other changes, we're still awaiting to get some additional information regarding what the new law is going to do. But at the end of the day, I think it's important that you start doing a number of things in 2018 as you prepare not only to pay your taxes now in April, unless you get an extension and so forth, but as you prepare for 2018 and at least for the next 8 years. So it's important to do a number of things. Number one, you should all be doing some kind of a budget in 2018, and the earlier that you can do that, the better it's going to be for all of you. Take a look at the budget. Take a look at, where your leakage is. I don't care how much money you put in your bucket or how much water you put in a bucket. If your bucket is full of holes, it doesn't matter. So it's not how much money you make, it's how much money you keep. So I think it would be very important for you to identify, what kind of leakage do you have, and how do you plug it from a business perspective. The second thing is take a look at your investment accounts, your 401ks, your IRAs, your mutual funds. Find out all the taxable leakage that you may have there. Many people don't realize that, if you have traditional mutual funds, obviously you're going to get a 1099 from the mutual fund company at the end of the day, and you're going to have to pay federal income taxes on the growth of that money. Some of it may be capital gains, other may be ordinary dividends or ordinary income, but you need to be reminded that you will be paying taxes on those assets. The other issue to take a look at is how many years are you away from retirement? And how much money are you funding your 401k or your IRAs with? One of the major type of work that we do for clients we do provisional income calculation, because our number one goal is to get our clients to the 0% tax bracket and get as much money in your pocket as you could possibly have. Now, in order to do that, you have to do proper planning. You have to have a little bit of time on your side so you can start rearranging the assets, because, I have met with brand new clients, and all they've been doing for years is rearranging the chairs on the Titanic after it hit the iceberg. So everyone knew that the ship was going to go down, but you still, and that's a true story, you still had people rearranging the chairs, making sure that everything was going to look good on the way down, and that's not something that you all want to do. So you want to take a look at that. You want to try to figure out how much money are you putting into your 401ks and IRAs, and how much can you shift to either Roth 401k or Roth IRAs. How much of it can you shift over to life insurance? Because at the end of the day, if you can walk away and have income coming in on an annual basis that is tax preferred, non-reportable from a business standpoint, then you are not going to care that much where taxes are going to be in the United States in the future, because you're going to be in a position where your assets are going to be totally protected from one of the major eroding factors that we have in this country, which is taxes. Now, obviously, no one knows who's going to be in power in the future, so you have to plan, for the worst, because that's something very, very important. And remember, this is the yo-yo syndrome. You're on your own. You should never allow anyone to dictate what your tax liability is. So one of the things that I'm striving to make certain that my clients understand is that, these new tax laws that just went into effect as of January 1 of 2018 is giving each and every one of us a tremendous opportunity that we need to make certain that we adhere to, that we understand, and that we then implement and make certain that we apply it in the best possible way for ourselves and for our families. Sometime next week, when I do my next podcast, we're going to talk a little bit about 2018 resolutions. I don't like to call them resolutions because resolutions very seldom come through, but I'm going to make a list of things that I feel are going to be very important for all of us to adhere to, or at least to address, with our families for 2018. And that's going to be exciting, because I'm going to try to make it as fun as I possibly can. As I did say, we were not going to spend too much time today. Just wanted to give you a little bit of update as to what's happening with all the new tax laws. As we get more and more information, because a lot of the new laws are going to be coming out, because I do want to make certain that we read all the specifics of it, to make certain that we can help as many clients as we possibly can. And as I always say in each and every one of the podcasts that I do, is our number one goal is to get our clients to change the way they see things. Because when they change the way they see things, the things that they see change. So again, thank you again for your time today, and I'm looking forward to seeing you, and Happy New Year to all of you again, and we'll see you next week. Talk to you later.